The semiconductor chill is getting chillier today. 30 minutes until the start of trading. I'm Vonnie Quinn.
And I'm Isabel Lee. Danny Berger is off. Bloomberg Open Interest starts right now.
Coming up, the chip sell-off accelerates as a surprise AI breakthrough from China rattles markets.
And streaming giant Netflix is also weighing on sentiment after delivering a disappointing forecast.
Also, oil continuing to rise as the US and Iran intensify their attacks beyond military targets.
We're looking at a lot of stocks today, Vonnie, but we have to look at chip makers. The AI trade is really showing signs of fatigue. You're looking at sky-high valuations, leaving traders very little room for disappointment. And now they're also weighing on the markets. And you're looking at a threat of a new low-cost AI model from China overnight. This is what rattled investors because it could send a lot of pressure and profits in margins across the sector.
Yeah, the stock's definitely down for a third day. It's been down 2 days in a row, and this is not helping. Also, Netflix, absolutely at the lows of the session now, down 11 and change after earnings last night, plunging after it forecast slower growth and higher costs for new programming efforts, including live events.
Let's begin with the AI sell-off. So China's moonshot is out with a new model that could threaten the standing of the U.S. as the global leader in AI. Bloomberg Tech host Ed Ludlow joins us now. Ed, there's no better person that I think we can talk to about this. So talk to us about the significance of Chinese models now being compared to the likes of Anthropic and OpenAI. And is this really just another DeepSeek moment or something bigger?
Yeah, it has a lot of the characteristics of the DeepSeek moment of January 2025. Kimi K3 is a highly performing model, but the economics of it are what's spooking the market today. In very simple terms, China is able to say, here is a model that is on par with some of the best from Anthropic and OpenAI, but on the training side, you are talking historically on the Kimi models, low single-digit millions of dollars on a dollar basis to train. And the token economics of Kimi K3 are priced like a mid-tier. So they're charging basically $3 per million input tokens and $15 per million output tokens. In simple terms, it's much cheaper to run. It's priced like a sort of medium, middle-of-the-road US model, but performs like the top tier. And so that is spooking markets. And you're right that at the core of it, if you look at where the pain is, both on the logic and the memory side, the capital expenditure deployers and the capital expenditure recipients, everyone's now saying, well, why are we investing so much at such a high level in NVIDIA compute if it's just not necessary to get a $2.8 trillion parameter model that can perform to that level?
Well, Ed, Silicon Valley must have known that something like this was coming or would come very soon and that there will be another one, right? So is it enough to cause hyperscalers and boards all over Silicon Valley to maybe rethink Capex spending or no?
We're saying in the Bloomberg News story that this is a surprise release from Moonshot. And, the market seems to be taken by surprise. The way I'm going to answer that is later in Bloomberg Tech, we're going to speak to a very prominent venture capitalist. And I'm going to ask to him, was this a surprise, right? There's been so much focus on how AI in China is approached on the basis of getting to the lowest dollar per token, getting the cheapest tokens. In the United States, the focus has been getting the highest quality tokens. That's been the state of play for some time. So the net result isn't a surprise. I think it's just the timing and sort of how it was released that the market's focused on today. All
right, well, we'll watch that interview and find out more. Ed, thank you so much. That is a Bloomberg Tech host, Ed Ludlow. Brent edging higher, above $85 a barrel now as the US and Iran intensify their attacks. President Trump addressed the nation in a primetime speech.
We're making a record investment in our armed forces, and we have the strongest and most powerful military by far anywhere in the world. We are likewise winning big in Iran, and you will see the fruits of that labor very, very shortly. America is back and doing really well.
For the latest, Bloomberg Washington correspondent Tyler Kendall joins us now. Tyler, has there been a shift in the administration's thinking in the sense that it's now targeting things like bridges and other types of infrastructure?
Right, Vonnie, I think it's fair to say that the U.S. has really expanded the scope of its efforts, both by targeting Iranian infrastructure, but also the fact that we're seeing the U.S. enforce its naval blockade deeper into the Persian Gulf. If we start with this latest wave of of attacks. We heard from Iranian state media confirm that the U.S. targeted and hit at least 6 bridges as part of what appears to be a bid by the U.S. to disrupt supply routes to a key Iranian port city and naval base that the IRGC uses to disrupt traffic in the Strait of Hormuz. Now, CENTCOM came out and said that they are actively working to ensure freedom of navigation in the Strait. And they put out this statement last night listing essentially everything that they've done so far this week, including redirecting at least 3 vessels, disabling 1, but then boarding another additional vessel for verification purposes. That happened in the Gulf of Oman, seeming to indicate that the U.S. has essentially expanded its boundaries of operations. Now, so far today, according to the data, the observable traffic remains very subdued. And Bloomberg News looked through the satellite imagery, and it is interesting because we're seeing there are now more Iranian-linked tankers actually getting through because they are trying to use that IRGC-approved route that gets them closer to that country. So it's definitely something that we should be tracking here because at this point, Vani and Isabel, we haven't really seen much indication that Iran is willing to give up its leverage when it comes to the Strait, as Iran itself is escalating its own retaliatory attacks against now U.S. allies in the region. That includes Kuwait this morning, confirming that Iran hit a water desalination and energy generation plant, which is now risking access to clean water in that country.
So, Tyler, do you think we're entering a significantly more dangerous phase of the conflict? Because, to your point, this is something like the 6th straight day of hostilities.
Right, exactly. The 6th straight day of the U.S. striking Iran. So at this point, we're going to have to see where it goes from here, Isabel, because President Trump has said that he would give Iran until next week to come to the negotiating table before we could see an even further escalation in attacks with the U.S. targeting more energy infrastructure. We had this reporting earlier this week from the Wall Street Journal that President Trump could be leaning toward expanding military operations, which could include an operation around Karg Island or even putting ground forces into play. But we've sort of seen some administration officials temper that reporting, like the Vice President J.D. Vance saying in an interview earlier this week the U.S. isn't looking to put boots on the ground. At this point, the White House has said that they would still be open to diplomatic channels with Iran, but it is very clear that the patience is running thin, particularly as we see these supply disruptions continue. The domestic pressure is only going to keep piling on to this administration as we get closer to the midterm elections.
All right. Thank you, Bloomberg's Tyler Kendall, for keeping us updated with all things Washington. As always, thank you for joining us. Now, on the earnings front, Netflix forecasts a second consecutive quarter of slowing sales growth and is pouring money into new kinds of programming like live sports and video podcasts. Bloomberg Intelligence senior media analyst Geetha Raghunathan joins us live. So, Geetha, thank you for joining us. Is this a sign of Netflix slowing growth, rather, a short-term pain, or do you think that it's a sign that maybe the streaming industry is maturing?
I think definitely, Isabel, the streaming industry is maturing, and we're kind of seeing that definitely all across the board. We saw that when, a lot of these streaming services stopped disclosing their subscriber metrics. But then what they did was they kind of shifted the focus to revenue growth and operating margin. Now, Netflix had basically promised, low double digits to mid-teens revenue growth. And we had seen that in many quarters, including, the second quarter, which they reported. I think the real problem that investors are having with is kind of wrapping their heads around the guidance that they gave for third quarter, which is a considerable slowdown from some of the quarters that they reported before, because we saw 16% revenue growth in the first quarter, close to almost 14% in the second quarter, and then now you see this guidance for 11.7%. And it basically just kind of really complicates the formula, because we have projected, or the Netflix model basically assumes at least a 12 to 13% revenue growth CAGR to get to some of their internal metrics by 2030, and that now seems to be in question.
What shifted, Geetha, that we didn't see? I mean, it is trying to take on YouTube TV, it is going shorter form, it's still investing in content and so on, but it seems that that's not enough to grow engagement anymore.
Exactly, Bonnie. So, they did put out their first half of 2026, what we watched, which is their engagement report. And while we did see an increase in the total number of hours viewed, so there was a 2% increase, and it's the highest ever, number of hours viewed at 97 billion. The problem is that on a per subscriber basis, that number, the viewing number is actually coming down. And so that is what is causing all of this, nervousness, because if you have declining engagement, does that ultimately lead to a deceleration in the top line growth? And then that, of course, sparks fears about whether they'll be able to keep pace with their operating margin expansion targets.
Well, investors certainly punishing them this morning in the pre-market. Geeta, thank you so much. Geeta Ranganatham from Bloomberg Intelligence. Let's get a check on the broader market now. It's not looking too much better. For the rest of the market, we have S&P, Dow, Russell 2000, all of those indices, their futures are pointed to lower opens. None more so, though, than the Nasdaq 100. It's a big sell-off for chips once again today, and not just chips, but also hyperscalers and really almost everything tech, bar a few names, which we will get to. We have the VIX trading almost at 19, so a little bit more fear as the sell-off gains steam. Bitcoin, which cracked 65,000 yesterday, is right back down below 63,000. We have gold below 4,000 as the prospect of rates staying higher for longer enters this market. And that's all with the backdrop of the Iran war escalating and crude oil prices back above 85 for Brent, in fact above 86 now for Brent and above 80 for WTI. Let's get a look at some other movers on our radar now. SpaceX down after delaying the first Starship launch since its IPO.
And Apple upgraded to buy at HSBC on its agentic AI and hardware pipeline. And Apple, I believe, Vonnie, it's outperforming for the highest since 2006, outperforming the NASDAQ.
Doing so well, but there's such a chill in the market today that even that is causing Apple to just be up less than 1%, a tenth of a percent in fact. Google is also lower. It delayed the launch of its newest AI Gemini model because it didn't meet standards, and that stock is down almost 3%. Coming up, sweet greens stuck in the red as investors grow worrisome about that parasite outbreak in produce. More on the restaurant industry next. This is Bloomberg Open Interest.
Now to high interest, a look at what's making headlines around the world. Trump Media will begin selling real-time access to Truth Social posts from its highest profile accounts through a new service called Trump API. So the feed, aimed at high-frequency and algorithmic traders, launches next month as the company looks to create a new revenue stream. Pricing wasn't disclosed. And wildfire smoke from hundreds of Canadian fires is choking cities across North America. Air quality has reached hazardous levels in Chicago, Detroit, and Minneapolis, while New York remains very unhealthy. In Texas, flash flooding has killed 2 people and forced evacuations as heavier rain is expected overnight. And the CDC says a Xylospora outbreak has been traced to shredding iceberg lettuce served at some Taco Bell restaurants in 5 Midwest states. Taco Bell has pulled the supplier's lettuce nationwide as a precaution while FDA investigates. Over 1,600 lab-confirmed cases have been linked to the outbreak.
All right, Elizabeth, thank you so much to Isabel there. Executives across the restaurant industry are taking precautions due to the parasite. We spoke to TGI Friday's global president on how he's handling it.
Number one priority for us is safety of our guests and safety of the team members that work for us. But what we are watching is where does the parasite potentially come from? There could be certain ingredients coming through the supply chain that could be more prone to it. And as we get more and more advice, if there are certain products that we think could have a more susceptible to cause this issue, we'll withdraw it from our supply chain to protect the team.
Well, joining us now is Bloomberg consumer editor Emily Cohn. Emily, how bad is this going to get for Taco Bell? How long will it take them to recover?
You know, it totally depends on how they handle it. I think we've seen cases like the McDonald's E. coli incident of 2024, where very quickly we learn what the cause is, where it's coming from, and it's able to be contained pretty quickly. McDonald's did not suffer long-term consequences of their foodborne illness outbreak in 2024. But then you look at a chain like Chipotle, which suffered for a really long time from a series of foodborne illness outbreaks. that had everything, E. coli, cross-contamination, and I think that was not contained. That took a really long time to recover from. The brand was really impacted by that. So it really depends what Taco Bell and the other chains that are tied up, that could be wrapped up in this, do to identify the source and contain it as quickly as possible.
From your team's reporting, how are companies like Sweet Green, Taco Bell, and Cava maybe changing their sourcing, food safety, or how they're serving clients? Have you been hearing anything?
So far, none of the big chains besides Taco Bell have actually changed what's on their menu. We've heard from some independent restaurant owners, which are the bulk of restaurants in this country, that they are removing lettuce from their menus, or that people simply aren't ordering it. I don't know about you, but I haven't been eating.
I had a sandwich yesterday and I said, hold the arugula.
Yeah.
No arugula.
So it changes. It'll be interesting to see if anything changes today. But so far, the only chain that really changed its menu, its supply, so far has been Taco Bell.
Is that the end of it now as we know it, Emily? I mean, this one supplier in Mexico apparently was responsible for these iceberg lettuces or what have you. Can we all just go out and eat everything again?
Well, I'm not in the business of giving people health advice, but I don't think we know all of the answers yet. I don't think we know, if this is being removed from the system now, people who ate this lettuce might only be, like 2 weeks ago, might only be getting sick right now. So I don't know if we know the full extent of the reach of this. We don't know how many people are sick and if it's linked to this lettuce. And I don't know if we will ever know that because this is a parasite that is really difficult to track. And it sometimes takes a week, 2 weeks to even feel the symptoms of it.
And I don't think there are confirmed cases in Sweet Green, but the stock is at least being punished by investors.
And I just want to mention that Taco Bell has said it voluntarily removed lettuce from a supplier and it will replace it within 24 hours at restaurants in affected states.
Okay, so I guess eat at your own risks. Thank you so much, Bloomberg's Emily Cohn of the consumer team, for joining us on this Friday. Coming up, we discuss the faltering AI trade with Sarah Hunt of Alpine Saxon Woods. This is Bloomberg Open Interest.
AI stocks getting pummeled once again as investors look for returns on investment, but one stock in particular standing out as a winner. Sarah Hunt writes, we have seen several of these AI wobbles and recoveries from them, but it's hard to miss that while these stocks are seeing a drawdown, Apple has reached new highs. Alpine Saxon Woods chief market strategist Sarah Hunt joins us. So is it the time for Apple to recover its mantle, Sarah, between now and when it starts releasing all of these new products that we're waiting?
Well, I think that you saw a large period of underperformance for a while, while all the other stocks that were so exciting because of AI and people kept criticizing them because of their strategy. I think at the moment that is not the problem for the other stocks, are not the problem for Apple. Apple is now, because it's got a hardware cycle coming and because people still look at it in that way, I think they're looking at AI as something that it can solve. The question is how exactly are they going to solve it? But at the moment, the excitement is not about that right now. And they haven't done to the same extent to their balance sheet what some of the other companies have done in raising cash to spend all that money.
So Apple may be a bright spot in the AI trade, but what do you make of the AI trade? Because as much as, these companies obviously have a real business proposition, they're also really whiplashed by a lot of headlines quite easily. Overnight we saw the Chinese AI startup Moonshot, and now you see the global chip sell-off affecting U.S. equities.
Well, it reminds me a lot, and not surprisingly, of the DeepSeek moment, too, which was like, this is all going to upend everything and everything's going to change. And then the question is, how is they being trained, and is that the same thing? I don't know the underneath answer to all of that. I do think that there was some vulnerability just on how much these stocks had run and what people were pricing in from a linear standpoint about earnings. And I think that there is going to be a question exactly both on the cadence of how fast you can build data centers and how fast everything can be put to work. And it may be that you see a little bit of a slowdown, but you're also seeing companies getting punished for Capex now, where they used to be rewarded. So there may be a silver lining in the fact that it slows down a little bit. We just have to sort of see how that plays out. And I'm not sure that the question on the business model continues to be, what is it? Is it token prices? Is it this? Is it that? And I don't think we know the answer yet.
No, and we also don't fully know, and maybe investors don't even know what they want. Do they want continued spending, or would they actually, in the end, prefer if some of these hyperscalers and other companies were a little bit more reticent to spend and maybe pull back on some capex plans?
Well, and that's where I think that there might be, I mean, it doesn't feel like a silver lining, but there may be in the slowing of a cadence to spend. You know, I think that the debt offerings have not been as well received as some of the equity offerings because there's a limitation there about how much that can run. And I think that there may be some capex exhaustion that you're seeing. And if it becomes a more regular cadence that you can say is repeatable as opposed to it has to go up by 40% every year, that might be more acceptable from an investor standpoint. But I think, again, we're in that space where the stocks have run so much, it's not a surprise to see some profit taking. And it's also really, we continue to look for what exactly the business model is going to be and how we can gauge whether or not that ROI is coming in. And I think that question is just going to continue.
Where then are you seeing compelling pockets of growth in this space, other than maybe the AI trade?
Well, interestingly, there's a whole bunch of places that are trying to catch up, right? You're looking at places like healthcare. You're looking at places like financials. You're seeing a big interest in biotechs. You're seeing some very early stage companies either get bought by larger companies and or people are starting to look at that space again. You know, we look at instrumentation in a company like Danaher. We look at cash flow for companies that are managing to thrive in an environment where it's not just dependent on one spending track. And I think that there are parts of the market that have been ignored in favor of the AI trade, and you may see some money start to rotate back into them. There's been a lot of rotation in this market.
And of course, we have to keep our eye on inflation because hostilities have escalated once again.
Yes, and I think that that's also something that there was a big relief when oil prices went down. There were some great we got some very good numbers. There's no stability to those numbers with the price of oil coming back over $80 and getting closer to 90 on Brent. And I think that that's something that the market had decided for itself, and investors had decided that this was going to happen this way, and then it did, and there was some relief in that. And I think there's some real concern now on the inflation front and whether or not that's going to do anything from the Fed's perspective. I think it's hard to raise rates and think that that's going to solve this particular inflation problem, but it doesn't mean that those odds don't change, and as those odds change, that makes investors very nervous.
Certainly the rate hike in July almost pretty priced out of this market, but not potentially for the rest of the year. All right, Sarah Hunt is sticking around with us. We're going to get a quick check of the market before the opening bell. Obviously, equity indices pointing to a lower open. Moments away from the start of trading and what's very likely to be a down Friday for equities. This is Bloomberg Open Interest. I'm Vonnie Quinn, and as you can see, we are pointed lower. And as we await for the beginning of equities to start trading, I can tell you very much down now. A chill in the air thanks to chip stocks. Not though perhaps for those who are ringing the opening bells, who have waited some time to do this. And we're looking at a couple of companies that are involved in the fusion and nuclear spaces. So if we take a look at the New York Stock Exchange, there you have Standard Nuclear ringing the opening bell today with big bright smiles, even though it might be a down day for stocks. And then we had this man on the show just a few days ago. In fact, on the occasion of his IPO, Greg Twinney of General Fusion. It went public via SPAC just the other day. GFuzz was the ticker, GFUZ, and high fives all around because it did pop the first day by 21% as well.
I do love when I look at those shots because everyone is indeed so happy. But maybe the markets, to your point, Bonnie, is not that happy today. You're looking at red on the screen across the board. For me, we have the AI trade really showing signs of fatigue as sky-high valuations leave little room for disappointment. And investors are weighing a new threat overnight that came out. The AI model from China called Moonshot that could pressure spending and profits across the sector. You're looking at NVIDIA down by more than 2%. SanDisk even lower by nearly 4%. And Advanced Micro Devices, or AMD, down by nearly 4%. So really red across the screen, Bonnie.
All right, Isabel, thank you. Netflix plunging after forecasting slower growth and higher costs for new programming efforts, including live events. We're back with Alpine Saxon Woods Chief Market Strategist Sarah Hunt. So Sarah, Netflix lower, but it's just another example of investors really punishing a stock that doesn't match expectations. It's going to be a great earnings season. It's already been a great earnings season. Why are investors so demanding?
Well, I think that this is just a sign of the fact that people are very willing to step away from something where you think that there's a disappointment. I think that for Netflix, it started with the whole arguing over who was going to buy Warner, like that whole thing sort of took the directional question of where they were going. And I think, I mean, anecdotally, I've just heard people complain about how long the next season comes to come when you've got a season that people are involved in and the content and switching to more live. I mean, I think that it's a question of strategic direction and whether or not there's some issues there. But I mean, other metrics are very good for Netflix, right? So it's not like there's something terrible happening here. It's just that expectations were sky high and they've come down a bit. And that punishment right now is people are moving out of stocks that disappoint and moving into the stocks that they think are going to do better very rapidly.
I want to pivot a little bit to the Fed. So markets seem to be pricing in a tougher Fed under Fed Chair Kevin Warsh. Do you think investors are overestimating inflation risk, or maybe they're underestimating a growth potential in the economy?
That's sort of been the argument for the last year or so, right? Which is where would the economy be if it wasn't for the Iran war? Where would the economy be if it wasn't for some of the things that were limiting it? I think that we have to collectively, investors are looking at what is the reaction function of the Fed going to be? What is the cadence of communication going to be? And how are we going to be able to understand as the data comes in, both what the Fed is looking at and how they feel about what they're looking at. And all of these changes are ones that are probably necessary, but they're also ones that are, in the near term, take away from what we looked at as historical relationships, because we're now looking to see what data they want to use more seriously.
Just want to point out that it looks like the Philadelphia Semiconductor Index is about to enter a technical bear market, although bear in mind it's up still 99% year over year, right? So that's the thing, we've had some massive gains, but there had been this rotation trade that was really, taking some investor money away, or at least some of these profits, right? Does that resume once we get over this whole, market wobble with the stocks?
It's going also to depend on what happens with some of the big AI IPOs, which people have talked about, right? Are we going to get some of those large IPOs? Because you could argue that maybe some of the rotation is people coming out of one place and going into another. But then you look at where SpaceX has landed, which is now below their IPO price. And it's hard to say exactly where that rotation is going to come. I do think that there will be a relief if people start to feel like they understand how spending is going to go. And right now, that question is, have we been counting on too much spending and it's going to come down? And what is that going to do? But these stocks have moved so much, it seems reasonable to take some money off the table and then sort of recalibrate. And I think that that's where we are. And then any bad news or any news that makes it look like, what are we going to do with this model? It just exacerbates that. So I would not be surprised to see sort of like it start to roll back into favor, but we sort of have to see what happens in the next couple months.
We have this red headline just now, Apple overtaking NVIDIA to become the world's most valuable company. So that's quite a headline we're seeing. And earlier you enumerated the bull case for Apple. You highlighted why it is a bright spot in the AI trade. Maybe talk to us a little bit about the bear case. Like, what could make this reverse?
Well, I think for Apple specifically, or for so I think that any problems with unit growth or any of the issues that people have been looking at now, it's like, okay, well, if the hardware is good news, then it better have good news on hardware. They've got a lot of stuff coming out. There could be a question about timing. I think just in general, again, people are looking to stay with the companies that have massive cash flow, that are not necessarily spending that cash flow. And what happened to the rest of the Mag 7 is that they started spending all of that cash flow. So I think that people are looking for that. But again, if you see expectations, this is a market that is running on a lot of high expectations. And if expectations are not met and or people have things to say about the future that are less secure, I think that's going to give people pause.
Just want to point out that Sweet Green is actually just charging ahead. It's up almost 17% right now. So I guess the whole idea that it is not Taco Bell and that is a potential Taco Bell solo problem is helping here. But it does bring to mind the question of the consumer. How healthy is the consumer, Sarah? I mean, we saw some of the luxury names really outperform this quarter so far. And curious, is the K-shaped economy still very much in place?
I think it is. I mean, and I think that that's, the cohort that has the most trouble with higher gas prices, the cohort that has the most trouble with inflation is not the highest spending cohort, which is why you see luxury outperforming. You sort of see the other side of that because it's the stuff in the middle that has more trouble. And I think that the consumer is generally speaking fairly healthy, but I also think you're starting to see people dip into savings. You're starting to see credit card balances go higher. And all of that is a little bit of a question about, okay, so what is that spend going to be? You may see spending elevated because people are worried about memory price things. So you're starting to buy, you're looking, maybe I'll buy a laptop now instead of in 6 months because I don't know where prices are going to be. So I think that there may be an acceleration because of concerns about different
It's too
layers.
late for the laptops, though, right? Didn't Apple already up their prices?
It's too late for the laptops, but it's that idea of inflation pulls forward spending, right?
Yeah.
Because you're worried that it's going to be more expensive later. And when I saw that announcement, I had done that almost a year ago. I was like, I know I kind of need a new laptop. I'm going to just do this before things get worse. But I do think that whether or not that pulls forward too much and then you get a backlash to that is something that remains to be seen. But that higher-end consumer is driving most of the consumer spending, and that higher-end consumer is doing fairly well.
We have another headline, which is SpaceX set to wipe $1 trillion from their peak value, about a 40% drop. A lot of headlines because you are here on set with us, Sarah. Maybe just very briefly for 1 minute, or even less. Talk to us about the M&A, the IPO pipeline. I mean, we have Anthropic waiting in the wings and maybe OpenAI, and these are valued very, very richly. Is that evidently going to bite us afterwards?
Well, so this is a different cycle. We haven't had an IPO cycle in a long time. There are a lot of companies that didn't go public in the way that most of us who have been around for longer than we'd like to admit took the time to go public or came public earlier. So there is this whole question about what does that mean for valuations and what does that mean for the market. The fact that we haven't had an IPO cycle in a long time also says that we've had a lot of money that has been concentrated as companies, buy each other and buy back their shares. So maybe the market does need some new blood in there in terms of the IPO. The question is those valuations and that richness. And a lot of that is predicated on things that we can't quite linearly extrapolate at this moment, but there's an awful lot of excitement about it. So there is a push-pull to that, and I think that you saw that with SpaceX, and it's also like they're not putting all that supply out on the market at once. So the question is the scarcity factor enough for investors to keep chasing that? And the answer is we are waiting to see how that plays out in the next few months and the next year. I think there's a lot that's going on that's very exciting. I think investors get excited by that, but there's also a question, to your point, of how much of that valuation is already in there before they even go public.
Yeah, all right. Well, Sarah, it's been a morning. Thank you so much. Good luck with your Friday trading. That is Sarah Hunt of Alpine Woods. Let's get a check on the stock market right now because it's going to be a deep red day. It feels like about half and half in terms of higher and lower, but the ones that are lower in terms of stocks are potentially the most important ones when it comes to the weighting in the index, right? So you have all of the semiconductors, 28 out of 30 in the Philly Semiconductor Index are lower right now, and the ones that are higher are just barely holding on to gains. And you have all of the mags, 7, you have just tech in general with the exception of Apple, as we were talking about a moment ago, performing badly. Here on the other side, you have, some consumer staples, for example, Walmart. You have some of the oil companies on higher oil, ExxonMobil and so on. Some of the health insurers and biotech stocks, United Health and Eli Lilly, with a little bit of a halo effect after earnings. And then obviously some of the companies that didn't suffer from the problems that we saw Taco Bell suffer from are also higher today, and they make up some of the 284 companies right now that are higher in the S&P 500. But if you look at sectors, it's probably more obvious because we do have all of the chip-related tech sectors all lower. Financials index actually giving some back this week after some great earnings. And then outperforming, you have energy and consumer staples, utilities, healthcare, all of the ones that benefit from higher oil prices, and perhaps a consumer that's hanging in there just a little bit better than we expected. All right, coming up, Citi's Jason Bazinet talks about the disappointing outlook for Netflix amid a major shift in the media landscape. This is Bloomberg Open Interest. And it's time now for our top calls. Some of the analyst action in focus this morning. First up, JP Morgan upgrading 3M, saying growth is starting to take shape thanks to AI data center demand that's spilling into other parts of the economy. Next up, a good day for Apple as it overtakes Nvidia to become the world's most valuable company. It's also getting upgraded at HSBC, of course, the firm saying Apple has a stronger product lineup coming and better AI tools. And finally, a down day for Netflix, down almost 10% now after a weak third quarter guidance overshadowed an inline quarter. Jefferies saying today the report strengthens the bear case as growth and engagement slow. Evercore ISI pointing to softer revenue and profit guidance. Piper Sandler saying investors are focused on slowing growth. Isabel.
Let's discuss Netflix further with Citi Media and Entertainment Research Analyst Jason Bazinet. He has a buy rating with a $100 price target on the stock. Jason, thank you for joining us. It's really I was going to say a great day to talk about Netflix, but maybe not so much with the stock down. But do you think that Netflix still has major growth runway, or maybe are the easy days of gains behind Netflix?
Well, the bears are certainly in charge, and when we speak to institutional investors, they want to put sort of a traditional, PE multiple on this of something in the low teens, and that seems to be the direction of travel. What I suggest to clients is there's quite a few levers that Netflix has at their disposal that are sort of underappreciated. The company talked about on their public call about new high-end tiers, new low-end tiers. So I could imagine things like paying extra to binge watch, right, and not giving that to every consumer for free, charging premiums for early access to their films. And so there are absolutely levers that they have at their disposal. Is the growth going to reaccelerate? I don't think so, but can it stay in this, double-digit range for a number of years? I think the answer is yes.
Yeah, I mean, that's actually a great point. I think a lot of people would pay a little extra to be able to binge watch, or just, they would tell themselves they wouldn't do it, but just to have the option there, right? So,
That's right.
Obviously these are things that the company is thinking about, and it's implemented so many new things. Why would it have a problem implementing these new things, Jason? Why are investors losing confidence?
Well, on this particular quarter, I think they lost confidence because Netflix has very carefully trained the buy side to sort of follow this simple algorithm, which is Netflix spends money on content, they drive engagement, that engagement allows them to ask for permission to take a price hike. And so what the buy side is looking at is the engagement numbers are falling, and so that makes investors very nervous that they're not going to be able to get pricing. That's sort of the soft hypothesis. What happened in the quarter that they just reported is in the United States, they announced a price hike that took effect in the second quarter, but the US and Canada's division of Netflix missed street estimates. And so what investors think is, they took the price hike, but because the engagement is down, they must have lost subs. Now, the company says that's not true, but it was a tactical data point that fed into that buy-side narrative, and that's why you're seeing downside performance in the stock today.
What about other initiatives of Netflix? Do you think live sports, podcasts, or even ads can become meaningful growth drivers? And if so, by how much?
Yeah, so we've argued for a number of years that the direction of travel, if you look more broadly in the entertainment landscape, is what I call open platforms. That is content that is not curated by some sort of expert. And so what does that mean? In the video world, it means YouTube grows faster than Netflix. It means in the publishing world, Substack grows faster than a lot of other publishers. And you can just go through the list of any sort of media vertical. It's the same pattern. Open beats closed. This is probably one reason why there is this visceral reaction to Netflix trying to go out and buy traditional media, because much like generals are often accused of preparing their battle plan to win the last war, the future direction of travel may be more around user-generated content. Netflix used to sort of scoff at this notion 2 years ago. They clearly have made some JVs where they're bringing in more podcast content and more content from content creators. And I think they just need to go in that direction, but probably go faster than what's been announced so far.
Yeah, it lost out most recently on Roku. Are there any other assets like that it might pursue again? Or were these, two particular assets that they wanted, and if they weren't available, it's not that they're just going to acquire for acquiring's sake?
Yeah, there's a number of potentially traditional media assets that they could buy. The one investors are talking about now is NBC Universal, which is getting spun off from Comcast in about a year. I think what would be more intelligent for Netflix to do is not to go back and try and buy IP or buy a traditional film and TV studio. The direction of travel should be, if Netflix goes out and makes some documentary about some crime that occurred, maybe give that content earlier, like a sneak peek, to content creators that will go do things on YouTube, right? And then put that user-generated content next to Netflix early, right? And then allow the consumer to go in, watch the Netflix show, but if they want to go deeper, not pop out of the app and go to YouTube, stay inside the Netflix app, and sort of watch user-generated content that's been created around something that Netflix has built. So this is a strategic, I think, shift that Netflix needs to go through. And then it's not necessarily it doesn't necessarily require M&A. What it requires is just a reorientation of how they spend their content spending to lean more into content creators.
Yeah, capture and keep. Yeah, exactly. Jason, thank you so much. Citi Media and Entertainment Research Analyst Jason Bazinet there. Coming up, South Korea changing the rules on leveraged ETFs to help curb market volatility. We'll break down the details. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. You're looking at a screen behind me that is going to be red because we're seeing a global chip sell-off spilling over U.S. equities. We have traders really rushing to exit their positions as they exit into these big names that have, yes, powered the bull market higher the past months, but have also become extremely expensive. You're looking at an S&P that's down by more than 1%, or maybe nearly 1%. The Nasdaq 100 down by session lows, down by more than 2%. The Russell is also down, and the Dow Jones is down, and the Philadelphia Semiconductor Index, this is a gauge of chip makers. It's entering what is called a technical bear market. It's down by 20% from its peak in June. So it's really all red in this space for me. A Bank of America fund manager survey this week said that the most crowded trade is, guess what, long semi. So we're really going to see how the rest of the day plays out. And overnight, we saw news from a Chinese startup, Moonshot, that rattled investors. So again, that's adding jitters. And here, let's look at some single names in this space. Nvidia is edging lower, down by nearly 4%, as well as Intel and AMD, all significantly lower. Apple actually is in the red, but it just overtook Nvidia as the most valuable company in the world, which is a big deal for Apple. And Apple also was upgraded to a buy at HSBC, so it's really a good day for the stock. Netflix is down by 11%. They reported disappointing earnings, and they said that they're expecting slower growth. I don't know about you, but I still binge watch Netflix. And SpaceX, obviously, it shed $1 trillion from its peak. So in an attempt to curb market volatility, we have South Korea temporarily halting new listings of single leverage stock ETFs, and the county's Financial Services Commission said that they will raise the minimum deposit requirements for ETF trading. And joining us with more is James Seyfert of Bloomberg Intelligence. He follows all things ETFs from the U.S. to Korea. So James, what do you make of this news, and do you think that this tighter regulation in Asia may spill over in the U.S.?
Yeah, I mean, I've been writing about for a few weeks now about how some of the single stock ETFs here in the U.S. might become the tail wagging dog, or in some instances are the tail wagging the dog of the underlying stock. I mean, it's unquestionable that it happened in South Korea with SK Hynix and Samsung. They just allowed these things to launch at the end of the May. As you mentioned, the regulators are trying to basically pour some water on this fire. I mean, what you have to realize here is that some of these single stock ETFs, they're the most traded ETFs and securities in Korea. It's not like they just became very big. Like, they became some of the biggest things happening in Korea. So that would be like a single stock ETF here in the US, I don't know, trading as much as SPY, which is the most traded security on the planet. I mean, maybe that's a little extreme, but we're talking unprecedented levels. And the regulators themselves have been like, we regret approving these things. And part of that just has to do with the South Korean retail traders. They just love to gamble and bet on these things. And it really was creating volatility in their markets.
Yeah, and that's partially because their markets weren't as big as ours, so maybe we don't see the volatility quite in our markets, James, but these are absolutely, I mean, they are multiplying at a rate that's terrifying, and I'm curious what they serve beyond the idea that a retail trader could get double the exposure to a stock, but why would they want to if they didn't have enough money to put down and invest in that stock anyway?
Yeah, so I mean, what do they serve? I mean, what you end up getting is, one, you can do this. It's a lot easier to do than doing margin. It's cheaper technically to get the exposure because you're getting basically institutional cost when you're getting these margin trades. There are plenty of reasons to be, hedging or betting on a single event that you want to have a short-term trading vehicle. The ETF industry is a massive tent, right? Like, you can have these vehicles that are built to be trading vehicles. The question is, are they being used properly as trading vehicles? In the vast majority of cases, the answer is yes. But as I've written in the past, there are some instances of some of these single stock ETFs, which, as you mentioned, are exploding. We have I think a few hundred of them now. They didn't exist before 2022. Where they are getting a little bit too big for the size of the underlying stock.
Yeah.
It's not the case that this is happening with NVIDIA or some of these other larger stocks, but from the small mid caps, it actually is an instance that I think the SEC is probably going to start paying attention to.
Yeah, and it's not just single stocks either. I bet today there's a lot of trading going on in SOXL and SOXS, right? James Seyfert of Bloomberg Intelligence, thank you so much for joining. And do tune in to ETF IQ on Mondays at 12 p.m. New York time. Coming up in the next hour of Open Interest, Joanne Su from University of Michigan walks us through the latest consumer sentiment data. We are 30 minutes into the trading session. Welcome to Bloomberg Open Interest. I'm Bonnie Quinn. Danny Berger is off, and we are off our lows, but boy, are we lower today. That chip sell-off is just gaining momentum, and that's causing the Nasdaq 100 to be down 1.8% as we speak. Again, with the S&P 500, we're off our lows, but still down about 0.8%. All that has the VIX trading at an 18 handle. And then if you look at WTI, we are up 3% plus a piece for WTI and for Brent crude. Now let's get to some economic data, because we have University of Michigan data coming out with one-year inflation expectations dropping. Let's get all of the details now. We'll break down the data with Bloomberg's Michael McKee, international economics and policy correspondent.
Good morning, Bonnie. Well, Americans are a little happier than they were, at least according to these preliminary University of Michigan figures. 54.4 is the sentiment number. That's up from 49.5, so back into positive territory. And one would think that may have a lot to do with gasoline prices these days. But the one-year Michigan inflation number, which of course the Fed is watching closely, did drop to 4.2% from 4.6%, a significant drop, but of course still well above the Fed's target. 5 to 10-year inflation, 3.3%. Unchanged from last month. The current conditions index goes up to 54.9 from 47.7, and expectations go up 54 from 50.7. So overall, a little bit more happiness, but again, these are still very low numbers for this survey overall. Americans not getting overly enthusiastic about where we are. And of course, a lot of this may change since the war has restarted. And Bonnie, I want to mention just before we go here that we have had another Fed official get on the record about inflation. Beth Hammack, the Federal Reserve Bank president of Cleveland, has published a note on LinkedIn this morning saying there is no conflict with our mandate. Inflation is too high. The labor market is right around my level of maximum employment. So it's beginning to look, when you put her together with Lori Logan's comments last night, that the unified Fed that we saw at the last meeting may splinter at the July meeting, and we may have some dissents if they don't raise rates.
Yeah, either splintering or the message is getting very firmly put out there to markets that, don't take all of these rate hikes off the table as you did for July, because you just might get one at some point soon. Michael, we're obviously also potentially going to see CPI data get hotter again with oil prices at these levels and the war escalating again. Might that happen as soon as next month?
It certainly could, because the oil prices started going up right at the beginning of July, and gasoline prices, they didn't come down as far. So they've started back up again, and that will show up in CPI. But even more important, we get the PCE numbers for the month of June on the date of the next Fed meeting. And analysts have now figured out between PPI and CPI what they think PCE is going to be, and they're predicting it's going to rise. We're not going to see the same movement that we saw in the CPI and PPI of dropping a little bit, especially core PCE is going to go up. And that's not good news for the Fed, which targets basically PCE and looks at core PCE as the best representation they have at the moment of inflation.
Yeah, it's a fascinating turn of events. Michael McKee, thank you so much there with all of the latest on FedSpeak and, of course, the University of Michigan data. And joining us now is Joanne Su, University of Michigan Surveys of Consumers Director. So, Joanne, just give us the breakdown here. It looks like people are a little bit happier, but they could be happier still. What's been happening?
Essentially, consumers are extending a 2-month increase in consumer sentiment this month. We're about 20% above where we were in May, but we're still at fairly low levels historically. What made consumers feel better this month? It's essentially the positive movement in gas prices for most of the 3-week period that we cover. Consumers are showing a little bit softer concerns about inflation on a number of dimensions, both for their personal finances as well as buying conditions for major purchases. But at the same time, cost of living, purchasing power is still the #1 priority for consumers, and they remain quite frustrated by the persistence of high prices.
So they do expect, however, inflation won't grow as much over the next year. So when your inflation expectations coming in at 4.2% as opposed to 4.6% the previous month, that would indicate that even if that's how they feel now, maybe they're not as pessimistic about the future.
That's right. They're not nearly as pessimistic as they were a couple of months ago, but 4.2% is still very high. It's still much higher than it was just back in February, not to mention back in 2024, before the tariff situation started to accelerate and consumers started updating their inflation expectations. So consumers, they're feeling a bit more optimistic about inflation, but they really still are expecting inflation to accelerate again in the year ahead, as well as the long term.
We typically ask how these break down along partisan lines, and if one side of the aisle feels happier essentially than the other side. Have we seen anything like that this month, Joanne?
Every month we see some partisan differences, but what's really interesting is that this increase from June was seen pretty much universally across the political spectrum, across age, across the income distribution, the wealth distribution, across education. Basically, all of the demographic groups were in agreement that things are a little bit better now than they were last month.
What about further out inflation expectations? So investors and University of Michigan survey participants, more meaningfully, looking for 5 to 10-year inflation to be around 3.3%. Where is that traditionally? Is that pretty high, or is that coming into line?
That is a little bit higher than what we were seeing in 2024, which topped out at 3.2% and was typically below that. And it's still much higher than what we were seeing prior to the pandemic, but definitely lower than last year. 3.3 is what we saw last month and this month. So the fact that it is flat, I think, is a glimmer of good news. But of course, we'd like to see it coming down.
So typically sentiment doesn't always translate into spending or not spending, right? At the same time, it's one of the data points the Fed looks at as one of the data points we have to gauge how the consumer is feeling. And I'm curious, what would we like to see the sentiment figure at? So right now, it came in at 54.4. You tend to think of anything over 50 as being positive for all of these surveys, right? But traditionally, what would be a very happy and potentially spending consumer?
So first of all, we want to see positive trajectories across the wealth distribution. Right now, we're seeing a pretty large wealth gap, so that the number that we publish is an average for the entire population, but we're seeing much higher sentiment for the wealthiest consumers. They tend to be the ones who are driving most of aggregate spending. But the rest of the consumers out there really are feeling pretty sour about the economy, largely because of cost of living. So we want to see is all of these groups moving on an upward trajectory. 2 months coming up from an all-time low is great, but we really want to see that we want to see that over the course of several months and to get out of this 50s range.
All right, Joanne, thank you so much for your time today. Joanne Shu of the University of Michigan. And just recapping that data that we got, the University of Michigan inflation expectations for 1 year out coming in at 4.2%. That was better than expectations and way better than last year's 4.6%. And overall sentiment coming in at 54.4, better than the 51 expected. Now, in terms of markets, we are absolutely off our session lows, particularly for the S&P 500. It's down just 0.6%. Travelers is the best performer in the S&P. It's up 7.6%. But you also have plenty of consumer staples and Casey's General Stores and Lyondell Basel, Archer Daniels Midland, plenty of industrials doing well. It's all of the chip stocks and all of the semiconductor stocks, the Mag 7 and so on, that are lagging today, and that has the Nasdaq 100 down quite substantially today. Again, off its lows, but still down 1.4%. Oil obviously continuing to rise. We're close to 87 now on a barrel of Brent. And then yields after the sentiment data, not doing too much, but they had been lower and staying lower. The 2-year yield at 4.1323, the 10-year yield at 4.5234. Let's get a look at some single stocks moving at this hour now. SpaceX set to wipe out more than $1 trillion in market value from its all-time high. The company called off its Starship rocket mission yesterday when some of its engines didn't fire up. Apple overtaking Nvidia to become the world's most valuable company. The iPhone maker benefiting from a broader rotation in the tech sector away from big spenders on AI. It's down now, though. And AI and chip stocks generally falling as a surprise breakthrough from Chinese AI startup Moonshot ripples through the markets today. Some investors are drawing parallels with last year's DeepSeek moment. Let's get more on this tech sell-off now with Mandeep Singh, Bloomberg Intelligence, head of global tech coverage. Mandeep, China was always not that far behind when it came to the next iteration of its AI models. What do you know about Kimi K3? Is it any good?
It is, and look, that's where these models keep, surpassing each other in terms of benchmarks, functionality with the new versions that they release. And in this case, look, we were in an environment where everyone was complaining that token costs were going through the roof, token maxing, and all these terms, and everything was getting very expensive in terms of deploying these models. So it's not a surprise to me that Kimi K is getting a lot of attention because these are open weight models. Their token costs are a fraction of the leading frontier models here in the US. And that's why I think it's really making the news. I still think there is a big gap in terms of the functionality, but on certain aspects, these models are very good. And that's why people are becoming selective in terms of using the appropriate model for the task at hand.
Look, with all of these models coming out, is there any possibility at all that some boards will say, listen, let's cut back on our Capex spending. We don't absolutely need only to use Anthropic and OpenAI. There's nothing wrong with some of these Chinese and other countries' models.
I mean, it'll be interesting to see if, enterprises are open to the idea of using, Chinese models at the application layer, given the sensitivity around data. And look, I mean, there are certain companies that are definitely trying this out. But to my mind, that's where the frontier models will do their own part in terms of driving efficiencies and making sure that on an overall total cost of ownership basis, they are not as expensive to use as the open source models. And that's where there are still gaps and different nuances around how it will be deployed at scale, if you're using something like Kimi 3.
Mandeep, I would venture to say that there's something else in the background as well. It's not just that this new model came out and it gave everyone a jolt. It's also the fact that President Xi Jinping gave a speech yesterday where he took on AI and said, we are embracing this. We're all in. We're going to do a fantastic job on AI in China, and we're going to teach other nations using our models as well. If China is all in on something, it's not great for the rest of the world. Look at what happened with EVs. Look at Germany's car industry. It's basically getting decimated thanks to China.
Yeah, I think with the LLM specifically, it's a lot more sensitive in terms of, what you are trying to do around the use cases that you're deploying using LLMs, the applications involved. So from that perspective, I do think, there is a lot of stickiness to using our models, and that's where the enterprises, yes, costs will be a factor for them, but they also want to think about the sensitivity of data and the long-term nature of these commitments. And so I think the frontier LLMs here will do their part in terms of driving efficiencies and making sure that, companies could use this at scale and without having to pay out of the way, for using these models.
What about Google delaying Gemini's next launch? Should we read anything into that? Is it going to affect the company at all, Mandeep?
I mean, they did lose one or two of their big, marquee researchers. So I think that probably played a part. And the model delays are never good for, companies like Google, which have been at the frontier. So from that perspective, I think this is allowing the likes of OpenAI and Anthropic to gain share. But I expect them to launch, something very soon. And that'll be comparable in terms of functionality with the frontier models.
Mandeep, has the story around chips changed enough that we continue to see this sell-off into next week? Or is this sort of a one-and-done deal where there's a lot of profit taking? You know, we're in the middle of the summer, volume is lower, perhaps people want to just get out of some of the riskier trades, they've made enough and so on. Or is this something a little bit more nefarious?
I mean, we'll find out with the earnings season. I think all these hyperscalers have to give us their Capex guide for second half and 2027. And the expectations are they will increase in a big way. So to my mind, this is more profit taking and, things had gone parabolic in certain segments of the market. And that's never good, when it comes to overall valuations and sentiment. So overall, I do think the usage continues to go up and people will care about costs, which is, I think, positive for the overall adoption of these LLMs.
All right, I guess tune in and see, right? Mandeep, thank you so much. Mandeep Singh of Bloomberg Intelligence. Coming up, oil is climbing as tensions between the US and Iran escalate. That's next. This is Bloomberg Open Interest. Now to high interest to look at what's making headlines around the world. New York City Mayor Zoran Mamdani says he won't accept an 18% pay raise approved by the City Council, even as lawmakers voted themselves their first salary increase in a decade. The mayor's salary would have risen to just over $305,000, but Mamdani says New Yorkers aren't worried the mayor is underpaid. Aston Martin is in talks with funds including BlackRock-owned HPS Investment Partners to raise new debt as it tries to strengthen its cash position. The financing could use a controversial drop-down structure, shielding key assets from existing creditors as the luxury automaker contends with weak demand, tariffs and ongoing operational changes. The US and Iran widened attacks beyond military targets, raising fears for a broader war. Iran struck US bases across the Gulf and infrastructure in Kuwait, while US strikes hit bridges and sites in southern Iran. Shipping through the Strait of Hormuz continues to slow as oil prices climb. Let's get the latest now from Bloomberg Washington correspondent Tyler Kendall. Tyler, any indication that the US is backing off these daily strikes? We've had 6 straight days of them now.
No, Vani, at this point, instead, we're getting indications from the White House that the U.S. is looking to expand its military operations, as evident by the attacks on infrastructure that you were just outlining there, but also that the U.S. military has appeared to expand its naval blockade in its enforcement. We got this statement from CENTCOM overnight saying that the U.S. military had boarded a vessel for what they said was verification purposes, and that happened in the Gulf of Oman, seeming to indicate that the boundaries of where the U.S. is enforcing this naval blockade has been expanded. CENTCOM went on to say that they have so far redirected at least 3 vessels and disabled another one since instating that naval blockade earlier this week. But at this point, we're still seeing some of those flows trickle through, including that of Iranian crude. The latest data analyzed by Bloomberg News from the research firm Kepler shows that the 7-day moving average for crude flows through the Strait of Hormuz fell from last week 9.4 million barrels per day to now 5.5 million barrels per day, as the U.S. is trying to ramp up the economic pressure, but also this kinetic action that we're seeing, those strikes on infrastructure, including at least 6 bridges that our reporting indicates those attacks were aimed at trying to disable those supply routes to a key port city and naval base that the IRGC uses to disrupt commercial traffic. So, Vanya, at this point, all eyes are on the Strait. All the focus is on the Strait as President Trump is trying to get Iran back to the negotiating table.
Yeah, and there was that report during the week as well that he had actually discussed, doing something on Carg Island, doing something more with Carg Island. The president obviously says he's going to be attending the World Cup final this Sunday, Tyler, but what is his schedule like for the next couple of days? What might we hear? When might we hear something?
That's a great question. Beyond his travel to New York, he has a few other policy meetings that are set up. So we'll have to see if there's any other sort of developments, as we know that the president has given Iran a deadline of next week to come to the negotiating table, or we could see U.S. attacks expanded to further energy infrastructure, though, of course, we've gotten deadlines from this White House before. So we'll have to see how that shakes out, because Iran is already starting to target energy infrastructure in the region. Overnight, we saw the first Iranian attack against energy infrastructure during this latest bout of fighting, targeting a power generation plant as well as a water desalination plant in Kuwait that is now threatening some of the drinking water in that country. So there is just so much risk of escalation at this point. President Trump himself, we know, has been speaking to different allies in the region who have urged him to shift some of his plans, such as backing off that 20% reimbursement fee that we had heard earlier this week. And we're getting some new comments from some other allies. Breaking a few minutes ago on the Bloomberg terminal, the French President Macron saying that he is urging the Strait of Hormuz to be reopened. So, Vonnie, at this point, we'll see where it develops. One other thing I'll put on your radar for what President Trump could be doing, likely talking to Capitol Hill, because right now they are working out whether or not they can approve any additional supplemental spending through a reconciliation package to help fund the Pentagon and the efforts related to the conflict in Iran. I would bet there are a few tense conversations that happen this weekend as we head into next week.
Well, we'll be on it. Tyler, you'll be on it specifically. Thank you so much. That is Bloomberg's Tyler Kendall in Washington. Still ahead, we're going to be speaking with Paul Segal, CEO of LS Power, one of North America's largest energy infrastructure companies, as another heat wave tests the U.S. power grid. This is Bloomberg Open Interest. This is Bloomberg Open Interest, a check on stocks now, and interestingly, we are actually well off our lows. In fact, there does seem to be dip buyers emerging. So if you look at the Dow, we're actually in positive territory at this point. Same for the Russell 2000, even if fractionally. But look at the Nasdaq 100. So obviously we're still in the red and it's down 1.1%. That was down as much as 2.75% earlier on chip stocks being sold off. Same with the S&P 500. We are crawling back up to flat at this point, down just about 0.5%. Now, if we take a look at some stocks that are really leading the moves, obviously Netflix is a big one. Even Netflix is off its lows, but still down 8.75% after disappointing after earnings. SpaceX, another huge one, but it's mainly the large tech companies, so the AMDs of the world, the chip makers, the SOX index, if you can see, down 1.5%. However, memory chip makers have turned around. So SanDisk, for example, is up 2.6% at this point. And we're also seeing some of the cloud, the neo-cloud providers like Nebius, for example, is higher. So let's just keep our eye on this market throughout the day and see if dip buyers emerge. And then perhaps it won't be such a bad week next week. Brent crude up 3% as well, and that is helping energy producers in this market. All right, coming up, we're going to be speaking with LS Power CEO Paul Segal about the strain on the U.S. power grid from extreme heat. This is Bloomberg Open Interest. Bloomberg estimates 64 million Americans are facing both extreme heat and wildfire smoke, putting fresh strain on an electric grid that's already seeing surging demand from AI and from data centers. Joining us now is Paul Segal, CEO of LS Power, one of North America's largest energy infrastructure companies. He also serves on the board of EVgo. Paul, something like this extreme weather event that we're having, it's both a heat wave, but also the Canadian wildfires sending smoke our way. What kind of pressure does it put on you on a daily basis?
The heat is always a stressor on our grid, but these are precisely the moments that the whole grid and the power and an energy system is designed to accommodate. So we plan for these events, and we just had some very extreme circumstances over the course of the last 2 weeks, going back to the period immediately prior to July 4th, and the grid performed admirably. No real issues.
You believe that the US got flat-footed when it comes to AI demand, data center energy demand, and so on. I think most of the world did, right? But the question is, how fast can the US scale up the answer to that demand? How are you helping out in that score?
So at LS Power, I think we try to step back and think about where we've come from and how we arrived at this moment. Just a couple of years ago, most of the US grid felt like we were reasonably well supplied. We didn't have a significant amount of demand growth. That all changed in a very short period of time. And our industry generally has a planning horizon, depending on the asset that we need to build and develop, that measures certainly in the years, often 5 years plus. So we finally began to see real price signals transmitted through markets to our industry a couple of years ago, and the sector is in the process of responding. The beauty of our industry is, with the benefit of the deepest capital markets in the world, great technology and entrepreneurship and incentives, we have a lot of tools that we can use to respond.
So what needs to happen? So for example, in the case of LS Power, where do you need to spend money in order to meet some of the needs that the US is going to have? Is it in the distribution, the transmission?
Well, we're going to need a lot of new transmission, and we're going to need a lot of new generation. And both of these things require planning. And the planning horizons differ as a function of the technology. If we want to build a new battery, it's a couple-year planning horizon. If we want to build a new large-scale gas plant, it's 5 years until we can deliver. So at the front end, we have to invest significant human resources and capital, risk capital, to create the option to build these plants. We have to get control of real estate. We have to do environmental permitting. We have to find communities that are interested in hosting power plants. And we have to get these assets connected to the grid. All of those require an enormous amount of work. They require time, and they require money.
Are they out there at all? I mean, it seems like no community wants a data center these days. Governor Kathy Hochul had to put in a moratorium of a year on these data centers just in New York State.
Again, I think the area where the U.S. is uniquely positioned is that we have 50 plus different jurisdictions, 50 different states, and each state has a different point of view. They compete with one another, and we go where we are wanted as a power plant developer. And there are many opportunities to build new plants. The key is finding the locations where it's appropriate to bring those assets.
Now, you did sign a $5 billion deal with Constellation, congratulations, but also a $13 billion milestone was reached with Energy, a combination of wind energy and some other assets. How is that going, and how do you plan to build on that?
So our transaction with NRG closed earlier this year. We sold them a very significant portfolio of gas-fired power plants. With Constellation, we purchased a very large portfolio of gas-fired power plants. We believe that both are very necessary as the grid, as growth on the grid is required. And we're in the process of getting all of our regulatory approvals and closing the Constellation transaction. We think that these are the right assets that will be essential to supporting the grid over the course of the next decades. They provide flexibility. We can accommodate additional renewable resources coming on the grid by being able to turn these plants up and down as necessary. And one of the things that we're very active in when we buy power plants, when we invest in power plants, is looking for ways that we can get more out of existing assets that are on the grid. And again, brings us back to what are the things that we can do quickly. We can change equipment inside of existing power plants. We can improve efficiency at existing power plants. We can add equipment that gets more energy and capacity out of those assets. And that's a meaningful part of what we will do after we close a transaction like the one we discussed.
So what's next for your company? I mean, I also want to ask you about Iran in the sense that there's obviously an oil shock going on around the world. Is that something that's impacting you on a daily basis, given that the US has plenty of natural gas and it's not really affecting US natural gas prices too much?
Well, I think you put your finger on it. The U.S. has really transitioned away from using oil or oil derivatives as a primary or meaningful fuel for our power generation system. We do rely very heavily on natural gas, and natural gas prices have been lower over the course of this year than they were a year or even 2 years ago. Oil prices set the price a very discrete and small number of hours in certain geographic locations, mostly in the wintertime. So our industry is fairly protected, fairly insulated from global oil price movements.
Do you see continued massive natural gas boom in the United States for years to come and lots more exports? Where do you see all that happening?
We do. We think that we're in a moment where we really need more of every type of technology. We need more solar, we need more wind. We are deploying a lot of new batteries. and we're in the process of creating doing the development work to be able to develop a lot of new and deliver a lot of new natural gas-fired power plants. Those new natural gas-fired power plants, combined with LNG exports to the global markets, are going to be a draw for new natural gas investment for many years to come.
All right, well, the very best of luck, and thank you for coming to visit us. That is LS Power CEO Paul Segal. And the pressure isn't just on the power grid. Brent trading above $86 a barrel as US-Iran attacks intensify. Rising oil prices creating another challenge in Washington. Joining us now is Nathan Dean, Senior Government Analyst at Bloomberg Intelligence and the author of the Washington Update newsletter. Nathan, the President addressed the nation for 25 minutes last night. And I'm curious, is this the beginning of many, many speeches where he will try to justify things like the Iran war and higher gas prices, for example, in order to try and protect his party at the midterms?
I think you're absolutely right. I mean, and we are going to see a lot more President Trump, especially walking around the nation and trying to address American voters. The one thing that the president didn't really do, though, last night is that last night's speech was about election interference in 2020. It didn't really address the number one issue that American voters have, and that's affordability. So whether it's high electricity prices or data centers or whether it's high oil prices due to the conflict with Iran, President Trump isn't really addressing that at the moment. I would expect that pivot to continue, or at least that pivot will begin, especially if you talk to Republican lawmakers in response to last night's speech. A lot of them are saying, look, 6 years ago, American voters really don't have that on the mindset at the moment. They really want to talk about affordability and what can the president do to actually keep the Republicans in control of Congress.
And it's interesting because he had the perfect layup, right? We had CPI data that was more benign than expected. He could have just, ranted on that for a while. Why did he choose to attack China 2 months before the Chinese president is supposed to be coming to visit?
I don't think it was so much of an attack on China, but it was something that, he really wanted to have this speech for American domestic viewers. And there is a lot of time between today and that meeting between President Xi Jinping and President Donald Trump where they can repair relations. So I don't really think that there's really much of an issue there when it comes to the U.S.-China relationship. Things like tariffs and things like, Chinese purchases of soybeans, that will probably come back to the forefront of that discussion, not so much election interference. The one thing I will say, though, is that when President Trump was really pushing the Save America Act last night, he was trying to put pressure on Republican lawmakers in the Senate to embrace this idea of the Save America Act. And Senate Majority John Thune has already said the votes aren't there, and Republican goals of trying to include this in the Reconciliation 3.0 process. We actually have a note that's going on the terminal as we speak that says we just don't think there's much of a chance of that.
Fascinating. And then also there's, Iran, which is making voters irate at this point. I mean, his approval ratings, the president's, were already very low. On this in particular, it's just not supported by the American public, and yet he's escalating. Will he continue to do so even as the midterms continue to approach?
I think he has to. I mean, this is one of those situations where if there was an easy solution, they would have already found it. And, it takes a couple of parties here to agree on what's going to happen between U.S. and Iran. And it's U.S., Iran, Israel, et cetera. There is really no easy solution here. And so President Trump continues to be mirrored down in what's going on with the Iranian conflict. And every day that he talks about Iran is a day that he's not talking about affordability. And to your point, when his approval rating is 37%, according to the latest Washington Post poll, American voters want him to address affordability. It's just that he's stuck with this conflict in Iran and he can't get out of it.
If the Save America Act doesn't have a chance of passing, what will the president do, Nathan? We've seen him sort of try to take retribution at times on Congress when things don't go his way. Can we expect more of the same?
So there's really two things that I think are going to come out when it comes to the Save America Act. Now, as part of this reconciliation process, up to $10 billion is earmarked for states to implement the Save America Act. It's not going to be exactly what President Trump wants, but if a state wants to embrace it, they're going to give them grants. And I think that actually would fly with the Senate parliamentarian. The next thing you're going to see is you're going to see President Trump use executive orders to the Department of Homeland Security, the Department of Justice, et cetera, to try and ensure election integrity going forward. But a lot of that is going to be met with court cases and lawsuits because, as a reminder to the viewers outside of the United States, voting rules are largely dictated by the states, not the federal government. And so we should expect a lot of that to go to the courts.
All right, Nathan, thank you so much. That is Nathan Dean of Bloomberg Intelligence for us in Washington, D.C. Let's get a check on these markets now, about an hour and 10 minutes into the trading session, the Friday trading session, where we apparently have been seeing dip buyers emerge. The Nasdaq 100 down just more than 1% now, so that's a far cry from its low point of the session, which was down 2 3/4%. That's as Brent and WTI continue to rise. We have Brent now close to $87 a barrel. Bitcoin way back down. It's just above 63,000 a coin. Gold is below $4,000 an ounce. And yields, while they have been coming down ever so slightly, we are seeing a little bit of the curve flattening. So the 2-year yield at 4.13 and change. The 30-year yield back down to 5.05. This as well after the Michigan confidence data showed that consumers are a little more confident this month, and certainly more confident than economists were expecting. That said, they could be more confident still, according to the survey. The dollar index really unchanged, trading at 100.74. And if we look at some other metrics for what's going on, some movers, for example, we'll see that it's basically all in the chips. So some of the other tech-related names are getting out at this point. They are doing better. The Neo Clouds, for example, are higher. Some of the memory chips are higher. But some of the rest of the Mag 7 and flash chips and so on are still lower. Netflix forecasting a second consecutive quarter of slowing sales growth as well, fueling investor anxiety about the streaming giant's future. That stock down 8.6%. Alcoa cutting its forecast for alumina production after operational problems in Australia overshadowing the company's record quarterly revenue. And Sweetgreen is one of those fast casual restaurants that is outperforming, up about 16%. You couldn't see it there, but it is up today after losing more than a quarter of its market value in just 4 days due to fears about the parasite outbreak tied to produce. We now know the FDA says that it was tied to a supplier to Taco Bell in Michigan, and it's been found in produce at Taco Bell in 6 states. Coming up, President Trump's media company makes a new pitch to investors. We give you the details next. This is Bloomberg Open Interest. Trump Media is making a new pitch to investors. Truth API is set to launch next month, and it'll give traders and investors real-time access to Truth Social posts from, quote, high-ranking accounts. There's no word yet on how much the service would cost. Joining us with more is Bloomberg's Matthew Griffin. So, Matthew, investors haven't been exactly enthusiastic. Trump Media's shares have been lagging. Is this turning around how investors view the company?
Well, Vonnie, from my conversations with investors this morning, they are not holding their breaths exactly. I was talking to Matthew Tuttle. His firm co-manages actually a leveraged ETF related or that tracks this stock. And he said, because we don't know how much money this is going to bring in, investors probably just aren't going to pay too much attention yet. So you look yesterday after the announcement, the shares up just about 0.5%. They're back down today with the rest of the market and still have lost about 3/4 of their value since Trump's second inauguration.
Yeah, I mean, they trade pretty meme-ish, right? But at the same time, they are down, as you say, a lot. What's behind the general weakness?
Well, some of it is that they have lost a bit of that meme-like quality. I wrote a story about this stock a couple months ago, and I remember talking to Steve Sosnick, the head strategist at Interactive Brokers, who thinks a lot about these kind of things. And he said, okay, so you have themes like the president and his family that really drove trading last year. But if they don't deliver money and they don't deliver share returns to investors, traders just lose interest. So this stock isn't trading in line with Trump's political fortunes, maybe in the way that it once did. And again, you look at the P&L here. This is a company that recorded a $400 million net loss in the first quarter with just $900,000 of revenue. A lot of that is accounting charges related to Bitcoin prices. Still, though, not the kind of results that investors want to see for any kind of long-term interest.
What else is the company involved in? How else is it trying to turn its prospects around? I mean, it seems to pop up every now and then as, an interested party in a deal or some such thing. But what else is it doing?
They have done a lot. They've pushed into prediction markets related to sporting events. They've launched investment funds related to defense, energy security, that kind of thing. They've bought Bitcoin. And maybe most notably recently, they announced a merger with a nuclear fusion company. All of this is these are very newsy topics. They're very closely linked to themes that Trump talks about a lot. At the same time, though, they haven't made the company profitable. And in the case of Bitcoin, again, with those accounting charges, they've really weighed on the income statement there. So that's just a consistent theme in my reporting is when is this company going to make money, especially on an annual basis?
Yeah, I mean, it's a bit of a mix and gatherum of, sub-companies. We'll follow your reporting, Matthew, and you'll tell us just when it does become profitable. Much appreciate your time. That is Bloomberg's Matthew Griffin. Coming up, Sunday's World Cup final pits Spain against Argentina, but there's a different battle brewing both on the sidelines and in the wind. We'll take a look next. This is Bloomberg. Some breaking news now. Lettuce grower Taylor Farms is recalling products tied to that parasite. So once again, lettuce supplier Taylor Farms has told U.S. regulators it's preparing to issue a recall of ingredients linked to a parasite outbreak that sickened thousands in Michigan and nearby states. We've seen the document. This is from Taylor Farms. Now, the scope of the recall, pretty unclear. We don't have a comment yet from a representative for Taylor Farms, but it is recalling products tied to the parasite. Now look at what's ahead for markets next week. Sunday, of course, Spain and Argentina face off in the World Cup final. Monday, the Farnborough International Air Show kicking off. We'll bring you interviews with the CEOs of Boeing and Airbus. Tuesday, we get earnings from General Motors. And Wednesday, big tech earnings kick off with results from Google and Tesla. Then we get the ECB rate decision on Thursday, plus American and Southwest Airlines report earnings. And that's your week ahead. As if this week wasn't a big enough one, you have even more coming next week. But let's talk a little bit more about the World Cup final, because even though it's not on a trading day, there will be lots of money made and lost, I'm sure, on prediction markets and betting markets. We're joined now by Bloomberg Business of Sports reporter Vanessa Perdomo-Maglione. So, Vanessa, what are we seeing in terms of... Well, let's start with sponsorship. So we have Nike and Adidas, right? And they were the two big ones going into this tournament. Who's left in terms of who's going to win all the new consumer?
Well, Adidas is really the only team, they're the only sponsor left. They actually have both teams, so they're coming out as the winners of this no matter what. Argentina and Spain, they kit both of them. And really for them, I think the bigger win would be if Argentina won, because Messi and the iconic blue and white stripes is one of the most sold jerseys in the world.
Are we seeing already sales move higher for some of these companies? And is it because of World Cup merchandise?
It's hard to say if it is because of the World Cup, because Adidas and Nike do keep that specific, spending a little bit close to the chest. But shares of Adidas have gone up in terms of, anticipation of the final. We've seen it go up, a few percent over the last few weeks because of how well these teams are performing.
And it does seem like Adidas were a little bit better prepared than Nike for something like this. They were getting their merch into shape back several months ago, as opposed to Nike sort of doing it on the way into the tournament.
Yeah, you'd think that they're so used to this. Both of these companies outfit teams for every World Cup, for all of these major international tournaments. But Adidas has put out, a lot. And in terms of, they put out jerseys for the U.S. Even though Nike outfits the U.S. on the field, Adidas came out with this replica jersey from 1994 that had people really excited, and that was well before the World Cup. So they've been winning this from kind of the start.
Yeah, I mean, retro is in, right? It's the perfect strategy. So what about also the players on the pitch? Because it's not just the teams that get sponsored, but the players can wear whatever they want in terms of their own sponsorships, right?
Yeah, so it does depend on what, they're doing on and off the field. Some people have their own particular sponsors, but they can only wear them when they're not on the field, when they're not at team events. But Messi has a long-term deal with Adidas. They make a lot of money from selling Messi jerseys worldwide. But in 2022, when that happened, this was the most iconic photo of Messi holding up his first World Cup trophy. So that could happen again in 2026.
Yes,
it would be great for them.
Yes, it could. Am I intimating that perhaps you have a favorite in this game?
It's hard for me. I love to see Messi and the GOAT win, and another reason that would be great for Adidas is because this could particularly be his last World Cup, and it would be a shame to see a GOAT of the game go out, and I love watching that, but I do think Spain might come out with a victory.
Yeah, I tend to be in agreement with you, although, again, Messi, definitely the GOAT. All right, Vanessa, thank you so much. That's Vanessa Perdomo-Maglione. Do stick with us because we are going to be speaking on Monday with Ethan Deffitt of Moneta, Andy Goldberg of Nomura Asset Management, and the CEO of ADI Global Distribution, also Nikki Shields of MKS PAMP. So that's a big lineup next week. We'll see what happens though today into the weekend as we see that sell-off pick up steam just a little bit again now with the Nasdaq 100 down 1.5%. Thanks for sticking with us through the week. This is Bloomberg Open Interest.